So good morning everyone. We are the Group 5 of Financial Management and we're going to discuss some part of current asset management. So I'm Ronaldin Bot and these are my group mates, Norin Bot, Manuel Andres, Ira Santiago, and Mercy May Santos. So the content of this topic are current asset management, cash management and its importance, current asset investment policy, temporary and permanent current asset, and zero working capital. So to start this, assets are any tangible or intangible property of an individual or company that produces economic value. In short, those are the things that makes money and has value and later gives benefits. It may be short or for long term or period of time. Tangible assets like equipments, machinery, buildings, vehicles, stock, land, and cash, while intangible, those are trademarks, franchises, copyrights, licenses, goodwill, patents, and the brand. So let's move to current asset. Current asset, it is also called liquid asset or short-term assets. These are assets that are expected to use or converted into cash or sell within one fiscal year or operating cycle. Examples are cash and cash equivalents, accounts receivables, prepaid expense, raw materials, inventories, and short-term investments. So now, what is current asset management? It is the handling or management of companies' current assets. Those assets that are equivalent to cash, typically inventories. Inventory are the raw materials used to produce goods as well as the goods that are available for sale. Accounts receivable or the money a company's customers owe for goods or services they have received but not yet paid for. And short-term investments like money market accounts, high-yield savings accounts, government bonds, and treasury bills. Although short-term investments typically offer lower rates of return, they are highly liquid and give investors the flexibility to withdraw money quickly if needed. And the purpose of current asset management is to keep the flow of company's income and liability in balance. So how can we know if there's a balance in the company's current assets and liabilities? We have this current ratio. It is the key to figure out if there's a balance in current asset management, and it is also known as working capital ratio, wherein current ratio is equal to current assets divided by current liabilities. So, for example, a company had current assets of $200,000 and company liabilities were $130 and the current ratio is $200,000 divided by $130,000 and the result is $1.54, meaning that the company has $1.54 to pay off for every dollar that the company owes. This is typically considered a decent current ratio, although what defines a good ratio will vary from industry to industry. Generally speaking, a ratio of $2 in current assets to every $1 of liability is considered decent. And that's the ideal current ratio, which is 2:1, or at least we have the same amount or more of current liabilities we keep or maintain in current assets as balance. If an organization has current assets worth $50,000, whereas the current liabilities are worth $25,000, then the current ratio would be 2:1.
I'm Norin Bot and I'm going to discuss the cash management. Cash management refers to a broad area of finance involving the collection, handling, and usage of cash. It involves assessing market liquidity, cash flow, and investment. In a banking institution, the term cash management refers to the day-to-day administration of managing cash inflows and outflows. It is to maximize the liquidity and minimize the cost of fund of a firm or a company. When it comes to creating and sustaining a company's financial stability, cash management is a key component. And since in all current assets, cash is assumed to be the king. Why? Because cash is very important in all types and nature of business. It is the most liquid asset, that is why it must be managed accordingly. Why do firm or companies need to manage their current asset or cash? Kasi hindi pwedeng mas malaki yung outflow of cash or na ilalabas na resources o pera ng isang company sa inflow of cash or yung pumapasok na pera sa company dahil pwede yung mag-result ng bankruptcy. So, in the next slide are the motives or reason for holding cash. First is the transaction motive. Payments toward planned expenses. Cash is required in business to meet operational expenses like the company's utility bills, salary and wages, traveling expenses, repair and maintenance or accounting expenses, taxes, and etc. And second is the precautionary motive. Cash is required as the provision to meet unexpected contingency in shorter period of time. So, dito, it is for emergency purposes. Like, if anything happens, there should be available cash if needed. At last is the speculative motive. Cash should also be kept to grab profitable opportunities of investment or profit booking as and when the prices are low or favorable. It is also refers to the desire to hold money for the purpose of investing and growing wealth over time. Kung yung dalawang nauna ay para sa mga nakaplanong bayarin or emergencies, ang speculative motive naman ay nakalaan para sa investment in the future. Speculative motive is a tactic used by investors or traders to hold cash so as to make the best use of any investment opportunity that arises later on. Example of cash management. Alpha & Co. has the policy of allowing credit of 30 days. ABC Limited has $10 million in cash resources available and has to pay $2 million to Alpha & Co. after the 30-day period. However, after the 30-day period, it has an investment opportunity of $10 million. So, paano nila gagamitin o ma-manage ng maayos yung cash dito? Since may kailangan silang bayaran at the same time ay may investment opportunity. So, the company can renegotiate its terms with the supplier, allowing more periods. In that case, the delay in payment will allow the company to use cash in the investment and then pay off the amount to Alpha & Co. at the later date from cash generated from other sources. Thus, proper cash management can take investment opportunities and maintain operation business.
Good day everyone, I'm Manuel Andres and I'm going to discuss about current asset investment policies. Working capital financing policies deals with the resources and the amount of working capital that a company should maintain. It is not only concerned in the amount of current assets but also about the proportions of short term such as commercial paper, trade credit, bank overdraft, bill of exchange, bank load, certificate of deposits, and long-term sources such as equity shares, preference shares, debentures, retained earnings, and term loans for financing the current assets. There are several working capital investment policies a firm may adopt after taking into account the variability of the cash inflows, cash outflows, and the level of risk. Current asset investment policies basically is choosing how to finance current assets, and these are follows. Hedging policy, also known as maturity matching policy, a policy which arrange the current assets of business to use perfectly match current liabilities. Fixed current assets are financed through long-term sources and fluctuating current assets are financed through short-term sources. When we say fluctuating, it means a unstable of frequent increase and decrease in the current assets due to the business state. This is a medium risk proposition and requires a good amount of attention. For example, if a bank loan is due to be paid after 6 months, the company will be ensured that sufficient amount of cash will be able to repay the loan on the date of maturity, even though it may or may not current sufficient cash. Next one is conservative policy. Tries to avoid risk involved in financing of current assets. This keeps the company assets and liabilities in sync with each other, with the assets valuing on the higher side in case of sudden difficulties. This is the lowest risk working capital policy and fails to ensure optimum utilization of funds. In this policy, working capital is financed through long-term sources such as term loans, debentures, equity shares, and etc. And some of fluctuating assets is financed through short-term sources such as bank loans. And third one is aggressive policy. A very risky policy. It requires a maximum amount of investment in current assets. Fluctuating assets as well as permanent current assets under this policy will be financed through short-term debt. And in this policy, debt is collected on time and payment to the creditors are made as late as possible. When we say creditors, creditors are maybe an financial institution or a person who you owe money. And when we say permanent assets, it pertains to assets which last long. For example, land, since land does not reduce value over its useful lifespan. Overall, the importance of working capital financing policy is to helps to ensure your business runs smoothly and includes managing your inventory, accounts receivable, and accounts payable. It also helps to maintain both short-term assets and liabilities to ensure you have liquid funds necessary to run your day-to-day operations. And that's all.
Good day everyone, I am Irem Santiago and I will report about the temporary versus permanent investment in current assets. Temporary investment. Commonly, firms experience short-run fluctuations in current assets. Temporary investments are typically bought and held for a shorter period of time, generally 3 years or less. They are typically suitable for needs and goals that are more immediate or in the near future. For example, retail department stores will have high levels of inventory around Thanksgiving. In January, the inventory should be low. So dahil tumaas yung level of inventory because ayun yung time period na may events. So in January, yung inventory ay dapat ibaba dahil nga magkakaroon ng pagbalanse rito. Permanent investment. Firms always have some minimum level of investment in current asset. Example, a permanent investment. As a firm grows over time, the level of permanent current asset also grows. For example, a supermarket chain with 70 stores will have more permanent inventory than a chain with 4 stores. Permanent investment are assets that an individual or company intends to hold for a period of more than 3 years. Permanent investments are not subject to any adjustments due to temporary market fluctuations. However, such investments may be written down to reflect declining market value. Dito sa graph, makikita natin ang pagkakaiba ng temporary and permanent current asset. Sa graph, makikita natin ang temporary current asset is nag-fluctuate or nagbabago, either tumaas o bumaba within that period, while yung permanent naman is nagsimula sa mababa hanggang pataas sa given time period. Dahil nga nag-grow ito each time period. Next is permanent current assets. Permanent current assets are the minimum amount of current assets needed by a firm to continue its operations. These are the current assets that are used for a shorter span of life and usually replaced by other current assets during a year of operations of the business. Examples of the permanent current assets are the inventory, assets that are depreciating very fast, cash, and accounts receivable. These types of current assets are essentially required by the business to exist and operate. Understanding permanent current assets. A company may divide current assets into permanent and temporary types. This nomenclature, however, does not apply in the financial statements. The balance sheet does not distinguish between the two types. A temporary current asset is a fluctuating asset and it came into being due to sudden changes in some activity within the business. For example, due to a seasonal demand, there is a sudden increase in the inventory to meet that sales demand, and as a result, there is a sudden increase in accounts receivable. And that's all.
Hi everyone, I'm Mercy May J. Santos. I'm going to discuss about zero working capital. Working capital refers to the funds maintained by an enterprise to manage its day-to-day running expenses. A company working capital affects its operational efficiency and short-term financial stability. Mathematically, it is the difference between a company current asset and current liabilities. So, working capital of a company can be positive, wherein its current assets are higher than current liabilities, or it can be negative if current liabilities exceed current assets. However, at times a company can also have a zero working capital. What is zero working capital? When an enterprise has the same amount of current asset and current liabilities, it has a zero working capital. Such a situation arises when a company current liabilities fully fund its current assets. So, as you can see in the example, if the company have a total current asset of 5,600,000 and total of current liabilities of 5,600,000, therefore, does not have excess of current asset over its current liabilities. It has zero working capital. So, if an enterprise can maintain zero working capital without accruing exclusive liquidity risk, it can benefit the firm operations.